They don't want zero unemployment. They want some slack in the system. And this is the bit people don't like hearing. Not that long ago, interest rates were being smashed down to emergency levels as fast as possible. And now they're completely reversed. So let me ask you something that no one in the news is asking. What actually changed? And don't say inflation. That's the lazy answer. What are they really trying to tell us? Who are they trying to slow down? And who are they trying to scare out of the market? Because here's the uncomfortable truth. Interest rates aren't about helping households. They're about controlling behaviour. And once you understand what they're really watching, you start to see why this reversal was inevitable. Here's what you're going to discover in this video. First, the two numbers the Reserve Bank actually cares about and why one of them should worry you more than inflation. Second, why interest rates were smashed, then rapidly reversed, and why that wasn't a mistake. It was the system doing exactly what it was designed to do. And third, right at the end, why interest rate rises wipe out some property investors every single cycle, while others quietly position themselves to win. You see, most people have no idea which group they're in. So let's start with inflation, with actual numbers. The Reserve Bank has a clear inflation target of 2 to 3%. That's the band they're comfortable with. A few years ago, inflation was sitting below that range. In some periods, barely above 1%. That's why rates were cut. The cash rate was taken all the way down to 0.1%, effectively zero, after multiple cuts, emergency settings. Then demand came roaring back. People spent, borrowing surged, property ran. Inflation didn't creep, it exploded. At its peak, inflation pushed past 7%, more than double the top of their target band. That's when the central banks panic. Because inflation at that level doesn't just make things expensive, it destroys savings, explodes purchasing power, and undermines confidence in the entire system. So rates had to move, but inflation wasn't the only problem. Now, if that sounds like Economics 101, stay with me, because here's where it gets interesting and where most commentators get it completely wrong. At the same time inflation was surging, unemployment was falling hard. Unemployment dropped into the low 3% range, levels we hadn't seen in decades. Now that sounds great, and from a household perspective, it is. But from the central bank's point of view, that's dangerous. And this is the bit people don't like hearing. They don't want zero unemployment. They want some slack in the system. Because when everybody's employed, people feel secure. When people feel secure, they spend. When spending stays strong, prices keep rising. So when unemployment is very low, they get nervous. When inflation is high and unemployment is low, that's the worst case scenario. That's when interest rates are weaponized. Now write this down. Central banks don't move rates to make you comfortable. They move them because behaviour changes. High interest rates slow borrowing, they slow spending, and yes, they increase financial pressure. That pressure is intentional. Interest rates were smashed down when the economy needed oxygen. They were reversed when demand ran too hot. Not because something was broken, but because it worked too well. Now let's talk about the rate moves themselves. After taking the cash rate down to 0.1%, the Reserve Bank didn't gently lift rates. They tightened aggressively. In just over a year, the cash rate climbed to around 4.35%, one of the fastest tightening cycles we've seen in decades. For many mortgage holders in Sydney, Melbourne and Brisbane, that's hundreds of thousands per month, every month, leaving the household budgets. That's not hypothetical, it's in real cash. And this is where people get caught out. They assume the pain is temporary. They assume rates will come back down quickly. They assume they just need to wait it out. That assumption is dangerous because central banks don't move rates to make you comfortable. They move them until behaviour changes. And here's the critical part. When you use interest rates as a blunt instrument, the impact is not evenly spread. Some people feel every single rate rise immediately. Others absorb it, and a small group, it's largely insulated. Same economy, same cash rate, very different outcomes. Now, if you're new here, let me explain why I'm so direct about this. My name is Dimpna Boholt. I'm a property economist and founder of I Love Real Estate, and I replaced my income with passive income through property. Not by predicting interest rates, not by hoping, but by building portfolios designed to survive cycles exactly like this one. If you want clear, strategic property thinking, not hype, not fear, hit the subscribe button now. I'll wait while you do it. You done? Good. Now, let's get going. I'm putting out a lot of content like this, and this channel is about helping people build financial freedom through property in 3 to 5 years, not 30 years. Earlier, I said interest rate rises don't hurt everyone the same way. This is where that matters. There are 3 types of property buyers in Australia. Interest rates affect each one of them very differently. Let's break this down properly, because this is where most people get it completely wrong. So type number 1, the owner-occupier. You buy a home to live in, no rental income, no tax deductions, nothing offsetting the cost. Every single rate rise comes straight out of your after-tax pocket. You earn money, you pay tax on it, and then with what's left, you pay your mortgage. When rates go up, you don't get a bigger paycheck to match. You just have less money for everything else. Less money for groceries, less money for holidays, less money for the kids. Owner-occupiers wear the full, unfiltered impact of every rate rise. There's no strategy to soften it unless you sell, refinance, or move. This is why so many Australian families are feeling the squeeze right now. Type number 2 is the negative gearing investor. Now here's where it gets interesting. A lot of people are being fed absolute garbage advice. A negative gearing investor buys a property where the rent doesn't cover the costs. The mortgage, the rates, the maintenance, property management fees, it all adds up to more than what the rent is coming in. So you're basically losing money every single month. Here's the pitch they sell you. Don't worry, you can claim that loss against your income. You'll get a tax deduction. You'll get a tax refund perhaps. And when the property goes up in value, you'll make it all back. Sounds good, right? Sounds clever even. Well, let me tell you something. The only person telling you that negative gearing plus interest rate rises is a good strategy is someone selling you overpriced property and collecting a big, fat commission check. That is the dumbest advice you will ever hear. Think about it. You're banking on capital growth to bail you out. You're hoping the property goes up faster than you're bleeding cash. And in the meantime, you're paying money every single month to hold an asset that doesn't pay for itself. That is the dumbest advice you will ever hear. Think about it. You're banking on capital growth to bail you out. You're hoping the property goes up faster than you're bleeding cash. And in the meantime, you're paying money every single month to hold an asset that doesn't pay for itself. Now add rising interest rates. Your repayments go up, your cash bleed gets worse, your tax deduction, it doesn't even cover the gap. It just softens the blow. You're still losing. And if capital growth stalls, which it does in many markets for years at a time, you're stuck holding a property that's costing you money with no exit in sight. That's not investing. That's gambling with a tax receipt. Negative gearing can work in very specific circumstances. Short-term, high-growth plays with a clear exit strategy. But as a long-term wealth creation plan, in a rising rate environment, it's a disaster waiting to happen. And people selling you this strategy are not the ones waking up at 3 a.m. wondering how they're going to make the next mortgage repayment. You are. And then there's type number 3, positive cash flow investors. Now let's talk about the smart money. Positive cash flow investors buy property where the rent covers all the costs and leaves money in their pocket every single month. The mortgage, the rates, the insurance, the maintenance, the management fees, all covered by the tenant, and there's still money left over. That is true positive cash flow. Now, do these investors make less on paper than negative gearers chasing big capital growth? Look, sometimes yes, but not always. Not if you're smart. But here's the difference. They sleep at night. When interest rates rise, they don't panic because the property still pays for itself. Their cash flow might tighten, their margins might shrink, but they're not bleeding. They're not dipping into their own pocket every month just to hold the asset. And here's the real power of cash flow investing. When rates rise and the amateurs panic and sell, the cash flow investor is still standing, still collecting rent, still in the game, still able to buy more when everyone else is running for the exits. That's how real wealth is built. Not by hoping, not by gambling on growth, but by owning assets that pay you to hold them, no matter what the Reserve Bank does. Let me give you a few examples in real time about what some of my students are doing, coached personally over the years, to get positive cash flow properties that still get fantastic growth. Let me tell you about one called, let's say, Michael. Now, Michael is in the game of building positive cash flow properties. And do you know, over just a couple of years through his buildings and concentrating on high positive cash flow residential properties, his passive income from those properties is at nearly $200,000. Think about that, $200,000 passive income over and above growth. And you know what? Those properties are in a great metro area that has had fantastic growth. His capital value has more than doubled in value in just a few years. So you're not trading cash flow for growth. You can have both. Let me talk about Jason. Now, Jason took a different path. And again, through coaching and mentoring, he was able to get into a commercial property. Now, some of you may not be thinking of commercial property, but he was able to get into a property, him and his wife, Deb. That property is positively geared after all the expenses are paid, all of the rates, the mortgages, everything. Most of that's actually paid by the tenant anyway. But that property is $94,000 a year positive cash flow. Plus, with what he did to that property, it increased in value dramatically. And he's got built-in increases through the lease ratcheting of the lease payments going up all the time. Just another example, different field. I thought I'd throw it in because it was commercial. And then you've got someone like Natalie and Giorgio. They didn't have a huge amount of money, but they wanted to have passive income because she wanted to have babies. She wanted to quit work and be able to still have a good, strong, steady income coming in. One of their properties, as an example, they bought it for, I think it was about $588,000 from memory. That property brings in $115,000 in rent. Did they buy it with that income? No. But they made that property a high yield income resi property. And by doing that, their passive income after they pay the mortgage and the rates and insurance and everything else on that property is still $40,000 a year positive cash flow. And again, it's in quite a good area. Now, you can also go into regional areas, and quite often a little regional property, particularly if you're doing things to the property to make it worth more. Evelyn and Will, they did a little one of those. What did it cost them? Around $400,000, $408,000, I think it was. That property with a little bit of a renovation, increased in value, great. They made a great increase on that, around $280,000. But you know, that little property, through keeping it, $6,600 a year positive cash flow. So a great return while they're making money on what they actually do to that property. So you don't have to sacrifice growth for income, but what you do have to do is be smart about the type of property that you're buying. Now, these aren't lottery wins. They aren't once in a lifetime deals. This is what happens when you buy with a strategy instead of buying on emotion. If you want to see what this looks like over time, let me give you a few more examples of people who've been able to just live off their passive income now. I mean, this changes your life. This is not about having a little side hustle that gives you a little bit of free money to go on a holiday. We're talking serious lifetime changes where you can live off your rental income after all expenses are paid, etc. Who can I talk to you about? Well, let's go to perhaps Jeff and Linda. Now, Jeff and Linda were on the farm, drought, and it was, dry, and cattle are dying, and you're buying hay and all of that kind of stuff. So a really tough life. They had bought properties over the years, but with no plan. And they bought whatever they could. And look, they did okay. They were able to increase their net worth to probably a couple of $1 million, I suppose, but they were negative cash flow. They were hurting to the tune of about $72,000 a year it was hurting them. So to turn that around from negative cash flow to positive 100 and a mechanism to keep going and be able to have great income and growth coming in, that completely changes the ball game. That's what takes you from doing what you have to do to doing what you want to do. I'll give you another example, starting from a very low base. Sam and Emmanuel, just starting out, they had $10,000. That's it, 10 grand. What can they do with that? Again, no strategy, no anything. But what they were able to do was start to put it into deals where they could build wealth. What they wanted was a home with a very low mortgage. Over a couple of years, not very long at all, they went from $10,000 to having a portfolio worth nearly $700,000 and an equity position of around $550,000, sorry. That's a very small mortgage that they've got, and in a couple more years, that'll be smashed to pieces and they'll be starting to work on their positive cash flow. So again, debt is something that you need to take into consideration, and you want to be debt-free on your home at the very least. Let me talk about Emma. Now, again, Emma had done some deals. She'd done a bit of property. She'd bought a home a number of times, and she had a block of land with an ex and things like this. Single mum. For her, it was about creating passive income. Even though she had a great job, she ran a great business, but she wanted the choice to be able to do anything she wanted, whenever she wanted, go anywhere she wanted to go, and take her daughter on experiences around the world. In the space of just 2 years, she was able to create $339,000 worth of passive income from her property investing and buy an amazing home only there in her dreams prior to this. These lives are changed. These lives have gone from just the ordinary having to work, having to do things, to extraordinary results. Same market, same interest rates, completely different outcomes. And that's the difference with strategy. Now, here's the part most people miss. And this is where opportunity shows up. When interest rates rise, a huge number of uneducated buyers and investors put their head in the sand. They stop looking. They stop attending opens. They stop bidding at auctions. Not because property suddenly became bad, but because uncertainty makes people freeze. And when the amateurs freeze, the professionals lean in. And this is when competition thins out. Fewer people at inspections, fewer buyers at auctions, less emotional bidding, more room to negotiate, properties sit longer, agents call you back, vendors become flexible. This is when educated investors quietly do their best buying. Same market, different mindset. Cycles don't push knowledge, they push ignorance. And this is why I'm unapologetic. I'm pro-property. Not hype, not blind optimism, but property bought with strategy, buffers, and cash flow. Property that doesn't need perfect conditions to perform. So now I want to hear from you. Here's what I want to know. Drop a number in the comments. On a scale of 1 to 10, how concerned are you about interest rates affecting your property plans right now? 1 means not at all. 10 means it's keeping me up at night. So drop a number. And if you want, tell me why. I read every single comment and they shape the next lot of content I create for you. So let's actually discuss this and see what the vibe is out there. And if you don't want to miss the upcoming videos, hit subscribe. I'm producing a lot of content around this exact topic. In my next video, I'm going to show you exactly how to stress test a property deal so you know before you buy whether it'll survive an interest rate rise. That's the video that separates the nervous from the confident. Subscribe so you don't miss it because cycles always repeat. The only question is, will you freeze when things get uncomfortable, or will you be the one who knows exactly what's going on? That choice is yours.